A big bank is failing. I'm your host, Steve Van Metre, and thanks for joining me today. And Credit Suisse is on the verge of going critical and triggering the next financial crisis. Let's over to CNBC where we picked today's story up. Credit Suisse may or may not be a Lehman moment, but something is going to break, according to Sri Kumar. I think the Federal Reserve is going to have to face the consequences of a credit event if it were to occur. According to Sri Kumar, the head of his own company, Global Strategies, he said something is going to break. This may or may not be a Lehman moment, he said when asked about Credit Suisse and referring to the collapse of Lehman Brothers in 2008, which triggered a string of big Wall Street bailouts and a subsequent financial crisis. Over the weekend, several media outlets reported that Credit Suisse sought to assuage investors' concerns over its financial health. The Swiss bank reportedly contacted its biggest clients after its credit default swaps rose sharply. CDSs are essentially insurance bets against defaults, and a credit event refers to a negative and sudden change in the borrower's ability to repay its debt. So what you're hearing here in these CDSs is a market saying, hey, Credit Suisse, you might think you're in good shape, but you know what? We don't. In fact, anyone who needs to buy insurance to protect themselves against the default from Credit Suisse has got to pay big. And that's why you're seeing these premiums rise, because the market's saying, Credit Suisse, you're much closer to failure than you think. But let's take the story back a couple days to see where it started. Credit Suisse is at a critical moment as bank prepares for the latest overhaul, according to the CEO. In the second carefully worded memo sent to reassure staff in many weeks, the CEO told employees not to confuse the day-to-day stock price performance with the Swiss firm's strong capital base and liquidity position. The shares are hovering near a record low. So again, just frame this, the CEO comes out as, hey, don't worry the fact that our stock price is plummeting here. It doesn't mean anything. We're in great shape. We're a great company. Everything's fine. The market must be wrong. Well, let's take that now forward a couple days because the market said, nah, we're right. Credit Suisse turmoil deepens with record stock CDS levels as Credit Suisse Group's gauge of credit risk rose to a record high, while its stock hit a fresh low, adding to the turmoil after the bank's attempts to reinsure markets on its financial stability backfired. While the credit default swap levels are still far from distress and are part of a broad market sell-off, they signify deteriorating perceptions of creditworthiness for the scandal-hit bank in the current environment. There's now a roughly 23% chance the bank defaults on its bonds within 5 years. Now, what do you think? Do you think Credit Suisse gets out of this intact, or do you think they'll fail? We'll look to the comments to get your thoughts. Credit Suisse markets capitalization has dropped to around 9.5 billion Swiss francs, meaning that any share sale would be highly dilutive to long-time holders. The market value is above 30 billion francs as recently as March 2021, showing just how weak the bank is. And bank executives have noted that the firm's 13.5% CET1 capital ratio at June 30th was in the middle of the planned range of 13 to 14 for 2022, suggesting that, well, nothing must be wrong. And the firm's 2021 annual report said the international regulatory minimum ratio was 8%, while Swiss authorities required a higher level, about 10. Again, suggesting that there's nothing wrong, but the market is saying very clearly here, we don't care what you're telling us. We know underneath Credit Suisse that you're much closer to failure. Somehow they have to come up with a few billion to cover the cost of restructuring, as management will try at all costs to avoid a dilutive share issuance, but they're forced seller right now. And that's a real key point here, is that what you're seeing is the bank, in order to afford its restructuring, is going to have to issue shares. And this is something that we've talked about on the show in the past, where at market bottoms, when companies need money, they're going to be forced sellers of stocks to raise capital. We're seeing it now potentially happen in the banks, and this being just the first leg to drop. And one thing that shouldn't drop when the banks go under is your portfolio. I'll put a link up here to Portfolio Shield and description below, because while we're looking at the symptoms and we look at Credit Suisse and see, hey, something's wrong here, what is the catalyst? Well, you probably could guess it. The Fed is breaking things. Here's what has Wall Street on edge as risks rise around the world. After being criticized for being slow to recognize inflation, the Fed has embarked on its most aggressive series of rate hikes since the 1980s. From near zero in March, the Fed has pushed its benchmark rate to a target of 3%, and at the same time, the plan to unwind its $8.8 trillion balance sheet is in process, or quantitative tightening. And we note that today, as according to today's recording, that there is a drop from Friday's sale. The quantitative tightening hits the markets today. Every 15th and every 30th is when they unwind. So look for more pain, as asset prices tend to have pretty high correlation to the Fed's balance sheet. The Fed is breaking things, according to a former hedge fund chief risk officer who now runs a different firm. There's really nothing historical you can point to for what's going on in the markets today. We're seeing multiple standard deviations, and this is a key point I want you to understand. Multiple standard deviation moves in things like the Swedish krona, in treasuries, in oil, in silver, like every other day. These aren't healthy moves. So in a normal functioning market, you do not get large, wild swings in prices. It's abnormal, it's unusual, it's telling you there's some major stress event under the markets that's going on. Credit Suisse may just be on the top of that pile. Such U.S. dollar strength has historically led to some kind of financial or economic crisis, according to Morgan Stanley. Past peaks in the dollar have coincided with the Mexican debt crisis of the early 1990s, the U.S. tech stock bubble of the late 90s, the housing mania that preceded the 2008 financial crisis, and the 2012 sovereign debt crisis, according to the bank. And that's exactly what we may be seeing here, is the higher dollar is actually causing a lot of problems, causing stress in the banking system. And again, Credit Suisse could be just the first of many banks that are going to have problems along the way. The second worry is that whipsawing markets will expose weak hands among asset managers, hedge funds, or other players who may have been over-leveraged, no surprise, or took unwise risk, also flagged under no surprise. While a blowup could be contained, it's possible that margin calls and forced liquidations could further roil the markets. When you have the dollar spike, expect a tsunami. Money floods one area and leaves other assets. There's a knock-on effect here. And so when you talk about Credit Suisse, and this is important to understand, that they're falling stock price, despite even if they are well capitalized, which I'm sure we'll find out in the near future that something is going on under the covers there. But if you're looking to do business with a bank and you have a lot of money or a big business, you're not going to look at Credit Suisse right now because you have lack of confidence. If you are a customer of Credit Suisse, you're going to worry about getting your money and start looking elsewhere. And it's these things that the banks find lead to problems. Money leaving, these means they have to raise more capital and puts them at a risk of going bust. But what about the Fed? Are they about to pause? Are they looking at this? Well, maybe. The Fed begins to split on the need for the speed to peak rates, as discussion is about changing the course as rate hikes definite over tightening to show in financial conditions. Hawks like Cleveland Fed Chief Loretta Metre said they must keep raising rates aggressively to win the battle against inflation, even if that causes a recession. And there you're hearing it now. The Fed is willing to put you on the unemployment line, crash the market, all to get inflation down. There you have it from the inside. Vice Chair Lael Brainerd has offered a slightly softer assessment while continuing to stress the need to tighten policy. Brainerd's speech on Friday, the first from the Fed board leadership since they had their last meeting, said policy will need to be restrictive for some time and avoid the risk of prematurely pulling back, indicating that they're likely to keep things tight. But could there be something that gives them a pause, something to get them to reconsider? Well, maybe today's ISM manufacturing data will be one of them. Here we can see from the ISM, the manufacturing PMI is at 50.9. Now, just so you understand how to read this, it's like a pendulum. The over 50 means expansion, 50 is unchanged, under 50 is in contraction. So we saw the pendulum swing way out, and now it's starting to say, hey, there's no change, no growth, no nothing, and it's starting to swing the other way. Let's look at the internals, because this could get the Fed to pause. We see new orders and employment contracting. Production and backlogs are growing. Raw material inventories are growing, but prices, inflation, increasing at a slower rate. Here, let's dig into the report. What do we see? New orders contracting, and that's not a good sign from growing. We kind of knew that from those Fed regional surveys. This was likely to happen. How about employment? Remember, this is a key thing. The Fed wants to see people losing their jobs. Well, they're going to get it. Here we see employment contracting from an expansion inflation in August. How about inventories? We see manufacturing inventories are rising. Not necessarily a good sign here. How about prices or inflation starting to slow? And backlog of orders are also starting to fall. In a backlog, well, that's usually associated with inflation. But it's not just the U.S. report that's a problem. Let's head over to our desk of our chief strategist, Jeff Snyder, who talks about China's data and saying it doesn't look good. China's government reported a modest rise in its manufacturing PMI from 49.4 in August to 50.1 in September 2022, suggesting no change in the prior month. The Caixin estimated manufacturing for small and medium-sized Chinese businesses deteriorated in September, sinking to 48.1, notably now in contraction. He says there's no rebound in China, or worse, it means much higher recession probabilities, leaving those to near certainly override any lagging consumer price tendencies from what's left of last year's supply shock. If you want to know more about what Jeff Snyder has to say, what our energy expert Tracy Schuchart has to say on the energy and materials sector, and my Momentum Timer Pro report, well, there is a limited time 50% off discount and on all future renewals. There's a link, Markets Insider Pro, in the description. The coupon code's on the website. Be sure to use it. Sign up now. It goes away on Sunday at midnight. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.